It is an everything must go kind of day on the markets. We're seeing a pretty sharp pullback on a broad base of stocks. We're also seeing weakness in the bond market as well. The catalyst, of course, was inflation in the U.S. coming in hotter than expected. While it is cooling on a headline basis, it does show that the road could be a little bit longer than the market had anticipated with respect to getting inflation down. Year-over-year inflation at 3.1%. That is below where it was before, but a little bit hotter, as I mentioned, than expected. This one-year chart kind of tells us that we are doing the work, even as that work is slowing. Nevertheless, the market totally got rid of rate cuts for the month of March and basically for May as well. And we're seeing that kind of repricing happen in the markets right now. Young-Yu Ma is the Chief Investment Officer at BMO Wealth Management in the U.S., and he joins me now. I mean, we got used to, right? Weeks after week after week, you just get nothing but 1% moves to the upside. Maybe it's not so surprising, regardless of what the catalyst is, that we get a little bit of a pullback.
Yeah, thanks, Amber. It's great to be here. It's not so surprising, but the data that came out this morning definitely sent a jolt through the markets and really awakened the markets to the idea that we might not be on this Goldilocks type path and that the Fed's interest rate cutting program might be pushed out much further than expected and come in much more gradually than expected. So I do think this is somewhat of a wake-up call for the markets here, and the grind higher that we've had since the beginning of the year is probably on hold for a while, and we're expecting some choppy markets going forward here.
So it sounds like it's prompting a rethink, not only for investors, but for you as well, in terms of how you thought the year might play out.
Well, I think for every 1 month of difficult inflation data that you have, you probably need about 3 months of good data to get the Fed back on track to thinking it's going to be focused on cutting rates rather than keeping them where they are now. So this inflation data that came in, even though it's backward looking, did have some very difficult components. There were multiple components, relatively broad-based, that showed inflation pressures elevating from the prior month on a month-over-month basis, and just far above what the Fed's target is if you project out that 1 month reading that we got in January. So I think this does cause some concern in the markets, and it's going to take more data going forward on inflation that comes in favorably to really shift the thinking back to where it was just earlier, just last week or in the prior weeks.
You know, we got to this point in the rally, though, with interest rates at 5%. And I understand that tech has done a lot of the work, but earnings broadly are also coming in better than expected. Do the markets need these rate cuts to continue advancing?
Well, earnings have been coming in pretty well, so that has been a pleasant surprise. The forward guidance is not bad as well, so I think that has also helped to prop up the markets. But certainly the markets have been focused on the idea that interest rates are going to be cut relatively soon, and that trajectory was going to be one that was more favorable than probably people are anticipating now, given those rate cut expectations are pushed out. Does the market need interest rate cuts is a good question. I think that we want to consider where valuations are now. And with valuations being relatively high, I would say that some of the market support is based on interest rates coming down later in the year and coming down to a meaningful degree. So to the extent that those valuations are high, we can still, I think, have a healthy market or at least a stable market. But to really see advances from here, I do think we need probably lower interest rates still to come down by mid-year.
This might be an inflammatory question, but what if we don't get any rate cuts? I mean, what probability do you assign to that? Is it higher today than it was yesterday because of today's read of inflation?
Well, it's definitely higher today. If we get another couple of prints like we had today, I think that that becomes a very realistic scenario. Now, the favorable news is that a lot of the forward-looking indicators that we track for inflation still show inflation coming down. We do still expect it to come down on a perhaps a bumpy trajectory, but still come down over the course of this year. Although wage pressures are still a little bit higher than they should be and probably contributing somewhat to those inflationary pressures. But what probability we assign of no cuts this year? I think there are two scenarios where we get no cuts. One is inflation is just too high, and that's today's print points to that at least as being a possibility. We don't think that's odds on, but another possibility is that the economy just runs hot and the labor market stays very strong, growth in the U.S. stays very strong, and the Fed decides to keep rates about where they are, maybe cutting once or twice rather than the 3 or 4 or 5 times that the market had been expecting. And that could be something as well where the Fed just doesn't meet the market's expectations. But in terms of no cuts, we think that's relatively unlikely still, maybe only a 20% scenario of getting no cuts this year.
Okay, so let's put this all into practice, what it means for your portfolio. We'll tie it up in a bow here. You're looking for maybe a little bit more volatility, more chop, risks that the number of rate cuts are going to be fewer than maybe the market had been hoping for. So where do you want to be in the market in that environment to ride through that?
Well, I think the first consideration, we're seeing this play out today, is that in terms of fixed income exposure and interest rate exposure, you want to be relatively short duration. I don't think that it pays to be long duration here. I think that the risk you're taking from being long duration is greater than the potential benefits you get from being long duration. And although the risks are always a bit two-sided, I think right now those risks are skewed to higher rates rather than lower rates if you're talking about where the tail risk lies. So I think that's one thing in terms of protecting a portfolio that investors can think about, relatively short duration. I do still think that U.S. equities are still a stable place to be. We think that the environment will still be healthy this year. We do think that it's reasonably likely that although we had this difficult inflation print, the trajectory still stays downward for the remainder of the year, perhaps bumpy, but still downward. But we're going to need to see more favorable inflation data prints to be more confident about that, and for the Fed to be more confident about that. But right now, we're not shying away from risk. We still think a balanced approach to the markets makes sense. We still like certain sectors in U.S. equities, such as infrastructure, technology as well. Biotech is having a difficult day because of rates going up, but we think by year end, biotech will also see better prospects.
Let's talk about tech, because sometimes talking about the market and talking about tech are the same things because of just how influential it is. But does that also present a downside risk? If there's any vulnerability there in that group of stocks, that is a vulnerability for the broad markets as well.
It definitely is, but I do think a lot of trends are going in the favor of the technology spend that's going to benefit those companies. So those trends are pretty strong here, and we don't think we're in the type of exuberant days that we saw in the late 1990s where a lot of these stocks became sort of unhinged from reality. The stocks that really are seeing the major benefits right now, yes, they are mega cap names. Yes, they have a very disproportionate weight in the indices, and at least have the potential, if there are meaningful stumbles, to bring down the overall index levels. But we do think the trends are quite strong there. So it does present a risk. It does present a reality that it's an allocation that's hard to avoid. And it's a risk, and that's also difficult to avoid because we do think the trends very much play into the favor of some of those mega cap names. But certainly that's the nature of the market we face now. It's just very lopsided into technology these days.
I want to, before I let you go, I want to ask about regionals, especially on a day where we're seeing such movement in the bond market. How concerned are you about a repeat or worse of what happened last year with Silicon Valley Bank?
Well, we did see some strains. New York Community Bank announced a major write-down based on commercial real estate loans. We do think there are other banks to come that are in a similar position in terms of their regional and small banks having more real estate, specifically office exposure, than their books can easily write down, and perhaps are not being fully reflected in the market right now. We do think that is something that could cause some hiccups down the line here, but we don't think it's a systemic issue. We don't think it's a large enough issue to bring down or to strain the overall financial sector. We think it's very isolated to some small and some regional banks that have overextended their loan portfolios at this time. So we don't think it's likely to cause the type of disruption in the markets that it did in March of last year. We think we could see some repeats like we saw a few weeks ago with New York Community Bank Corp of causing concern, but not enough to really cause a large downdraft in the markets.
All right.